$12.47. That landed in someone's account this morning. They didn't work for it. They didn't sell anything. They just owned a stock. It started with $500. In a minute, I'll show you the one number most beginners never check, and it's the exact reason so many people lose money in dividends. If you've never invested before, no finance background, no big savings account, this video is exactly for you. By the end, you'll have a clear step-by-step plan to start your first dividend portfolio with just $500. Jargon, no fluff, just the actual steps. At the very end, I'll give you a simple 5-point checklist you can save and reuse every time you look at a dividend stock. Quick note before we start. This video is for educational purposes only. I'm not a financial advisor. Nothing here is personalized financial advice. Always do your own research before making any investment decision. Here's exactly what we'll cover today. First, what dividends actually are and why they work. The 4-step system to build your first $500 portfolio. Third, the real math, what $500 actually becomes over time. Let's get into it. What is a dividend? Let's keep this simple. When you own shares of a company, say Johnson & Johnson, that company pays you a portion of its profits. Every quarter just for holding the stock. Think of it like this. Imagine you own a small piece of a vending machine business. Every time someone buys a snack, you get a cut of that sale. You didn't operate the machine, you just own a piece of it. Dividends work exactly the same way. You own a piece of a business. The business earns money. They share it with you. Here's the myth I want to bust right now. Most beginners think you need $10,000, $50,000, maybe even $100,000 before dividends mean anything. That is not true. $500 invested consistently, with dividends reinvested, compounds faster than most people expect. I'll show you the exact numbers in a few minutes. The key word there is reinvested. Remember that, it matters more than the starting amount. Okay, 4 steps, let's go through each one. Step 1, open the right account. Before you buy anything, you need the right account. US beginners, there are 2 main options, a Roth IRA or a regular brokerage account. Here's the difference that matters. In a Roth IRA, your dividends grow completely tax-free. You pay 0 taxes when you withdraw in retirement. A regular brokerage account, you pay taxes on dividends every single year. A Roth IRA first if you're under the income limit, which is around $161,000 for single filers. Fidelity, Schwab, and Vanguard all offer free Roth IRA accounts. No minimum to open, takes about 10 minutes. If you skip this step and go straight into a taxable account, you could lose 15 to 20% of your dividend income to taxes every year. That adds up to thousands of dollars over time. Step 2, choose your starting investment type. With $500, you have 2 paths. Individual dividend stocks like Coca-Cola or Realty Income, or dividend ETFs, which are baskets of many stocks bundled into one. A beginner with $500, ETFs are the smarter starting point. Here's why. When you buy one ETF, you're instantly diversified across 100 or more dividend-paying companies. If one company cuts its dividend, it barely affects you. If you put your entire $500 into one high-yield individual stock and that company cuts its dividend, you feel it immediately. Start with 1 or 2 diversified dividend ETFs. Keep it simple. Diversification protects you while you're still learning. Step 3, check the yield, but not how you think. Dividend yield is the percentage of the stock price paid out as dividends each year. If a stock costs $100 and pays $4 a year in dividends, that's a 4% yield. Here's where beginners go wrong. They see a 12% yield and think, amazing, I'll take that. A high yield is often a warning sign, not a reward. Yield above 8 to 10% usually means the stock price has already fallen, which makes the yield number look bigger artificially. The company may be in serious trouble. For yields in the 3 to 5% range from companies with 10 or more years of consistent dividend payments. Anything above 8%, stop. Research it carefully before you touch it. Me give you a quick recap of where we are before step 4. Right account, Roth IRA. 2, ETF over individual stock. 3, yield in the healthy 3 to 5% range. More step, and this one is the most important. Step 4. Turn on DRIP. DRIP stands for Dividend Reinvestment Plan. When you turn this setting on inside your brokerage account, every dividend you receive automatically buys more shares. You don't have to do anything, it's completely automatic. This is where compounding actually happens. Here's the difference. With DRIP on, your dividends buy shares. Those shares pay more dividends. Those dividends buy more shares. It snowballs over time. With DRIP off, you receive cash, maybe spend it, and your portfolio barely grows. Every major brokerage has this setting. It's usually one toggle, takes 5 seconds to turn on, and most beginners never do it. Turn it on from day one, never turn it off. Okay, let's make this real with actual numbers. You have $500. You open a Roth IRA on Fidelity. You buy into a dividend ETF with a 4% annual yield. You turn on DRIP. In year 1, your $500 earns $20 in dividends. That $20 automatically buys more shares. Let's say you also add just $50 a month. That's $600 a year, not a huge amount. Here's what happens over time. After year 1, your portfolio is worth around $1,100 and you've earned about $45 in dividends. After 3 years, around $2,600. About $104 in annual dividends. After 5 years, around $4,500. About $180 in annual dividends. After 10 years, over $10,000. And more than $400 a year in completely passive dividend income, from $50 a month and $500 to start. Here's what most beginners miss, and this is the answer to the question I opened with. The number most beginners never check is their own consistency. The yield, not the stock ticker, not the market timing. The person who invests $50 every single month without stopping will always beat the person who starts with $2,000 and never adds anything. Consistency beats starting amount, every single time. Let me show you something important before we move on. There are 2 paths a beginner can take. Path 1, a diversified ETF, 4% yield, drip turned on, adding money consistently every month, boring, steady, it works. Path 2, a single high-yield stock, 11% yield, drip off, no consistent contributions, exciting at first, until the dividend gets cut and the stock drops 30%. The boring path wins, almost every time. The mistake. And this one catches almost everyone, including people who have been researching dividends for months. The mistake is waiting until you have more money. I'll start when I have $2,000. I'll start when the market dips. I'll start next month. Here's why this is so costly. Every year you wait is a full year of compounding you never get back. Someone who starts at 25 with $500 will almost always end up with more wealth than someone who starts at 35 with $5,000. Because of time, the fix is simple. Open the account this week, buy 1 ETF, turn on drip, set up a $25 or $50 automatic monthly transfer, then don't touch it. That's the entire system. I promised you a checklist at the start. Here it is. Number 1, open a Roth IRA on Fidelity, Schwab, or Vanguard. It's free. Number 2, choose 1 diversified dividend ETF to start. Number 3, look for a yield between 3 and 5%. Avoid anything above 8% without serious research. Number 4, turn on drip immediately. 1 toggle, 5 seconds. Number 5, set up automatic monthly contributions. Even $25 counts. Action you can take today. Go to fidelity.com, click open an account and start your Roth IRA. Free, 10 minutes. That's your only job today. That you know how to start. The next question every beginner asks is, what should I actually buy? In the next video, we're going to break down the only 3 dividend ETFs beginners actually need. And which one I would start with if I had just $500. If you found this helpful, consider liking the video and subscribing for more simple, no-hype investing guides. See you in the next video.